the equity method versus this initial value method is going to have the same S entry and the same A entry. But the amortization, that excess amortization, is basically, entry I, equity income accrual including amortization gets eliminated under the equity method. Under the initial value method, this I entry is used to eliminate the dividend income account and the subsidiary's dividend account for what it's paid. With the D entry under equity, we eliminate the intra-entity dividends by the subsidiary. But under this initial value method, there's not going to be an entry for D. And the E entry is going to be the same as the equity method. It's great if you look at page 108, it really helps you see what entries are similar and what entries are changed based on the methods. Again, remember, internal reporting only. Now, two entries differ as it relates to the partial equity method. The S is going to be the same. The I is going to be the same. The A is going to be the same, but the I entry, the equity income, gets eliminated. So the parent's equity in the sub basically gets eliminated. It reduces the investment account. The D entry is going to eliminate the dividend income account, just like the equity method. The E account is going to be the same as the equity method. So you see here the ones that are similar. The difference between the initial value and the partial equity are entries I and D. So just so you are familiar with how the partial and the initial value differ. S, A, and E are always going to be the same, all three methods. The parent's record keeping is going to be related to journal entries. It's going to be an annual accrual of the subsidiary income and showing the dividends. The investment and the income account balances are what really differ for the other methods. Entries I and entries D are going to vary. So, when we're dealing with the future years, we're going to talk about how we're going to consolidate these financial statements. As you see, the equity method really presents the best picture of the income from the subsidiary. The initial value or the partial equity method does not provide full accrual of the subsidiary's activities. Initial value is based a little more on cash. Partial equity, a mixture of both of them. So you see the initial value method primarily uses cash for income recognition. And the partial equity method partially accrues some income. So there will be some adjustments on a worksheet so we can convert the parent's beginning of the year retained earnings balance to that full accrual basis when we use these two methods. So when we consolidate, we're going to have to increase the retained earnings account under the initial value method, or in the case of the partial equity method, decrease it so we're in line with the equity method. Entry C, which only occurs after the year of acquisition, The conversion is what C stands for. It's being made to equity method full accrual totals. So this is primarily related to transactions of prior periods. The C entry gets recorded before other entries are recorded to help us start off with the right balances at the beginning of the period. So we've got the S, the A, the I, the D, the E, and the C entries. Now we're talking about entry P. This is an entry that is recorded during the year of acquisition and then subsequently after acquisition. This basically eliminates any of the intra-company debt or receivables that are between the two companies we need to get rid of or eliminate. Basically, if we use, and this is something I'm just trying to continue to point out, no matter what method we're going to use for internal reporting, the consolidated financial statements will always be the same. We're just going to need to do some adjustments when we're using the initial value or partial equity method, because they're all going to get eliminated in the end anyway to do the consolidation. So, as we're dealing with after the acquisition, when we're dealing with the current revenues, we are going to, of course, include all parent revenues, and we will include subsidiary revenues after the acquisition. Current expenses, of course, all parent expenses get included, and we're going to include all of the subsidiaries' expenses from the day of the acquisition forward. And then we amortize that excess fair value over the book values. We're going to have to create an amortization entry, and that's going to be a part of the worksheet. When we're dealing with the investment income, the income that was recognized by the parent is going to be eliminated, and basically the subsidiaries' revenues and expenses take the place. When we're talking about the retained earnings balance, the parent balance is always included, but the subsidiary balance since acquisition gets included either as a regular accrual by the parent through the worksheet that increases the parent balance, and along with that, any prior amortization expenses of the fair value over book need to be shown either on the parent balance or through a worksheet entry to make it match. Related to our assets and liabilities, as you can see here, the parents are included in everything. The subsidiary balances get included once we adjust them at acquisition date based on fair values. So we're not going to use those book values. We're going to continue to use those fair values at acquisition date. And we'll make sure and eliminate any intra-entity transactions as it relates to payables and receivables. Then the goodwill in the investment, the original value is included, and basically we have to eliminate that investment account so that that balance isn't part of all of our consolidated figures here. The capital stock and additional paid in, they're going to be parent figures on the consolidated statements, Now, the parent balances will have been adjusted when we prepare the journal entry to acquire the company. But again, none of the subsidiary equity section is going to be included. So, based on this internal accounting method, excuse me, that is my puppy sleeping, if you hear that noise. The parent's internal accounting method, we've got three options, but in the end, the consolidated financial statements are going to have the same figures and same numbers no matter which method we use for internally keeping track of the subsidiary's income. So, how do companies choose which method they use? We know it doesn't ultimately affect the ending figures, but as you see here on the bottom, the internal method accounting used does require procedures for consolidation of the financial information from the separate organizations. So no matter what method we use, those entries we use on the worksheet to consolidate are going to be different based on the various methods. Now, Goodwill does not get amortized, but we're going to have to test Goodwill annually for potential impairment. This is required. So as we talk about Goodwill, the key here is that we don't want to overstate our goodwill if in fact there's a reason that it's been impaired, and we'll need to write it down in that period of impairment. FASB 350 talks about the effects of impairment related to business combinations. So when we're dealing with subsequent to the acquisition date, generally accepted accounting principles require that we test for impairment rather than amortize goodwill. So how do we go about testing for impairment? We are going to have the value of goodwill on our books based on the consideration provided and the specific changes in various account fair values. And it's going to stay that way until all or part of that subsidiary gets sold, or there's been a permanent, not a temporary decline, but a permanent decline in value. In that situation, we're going to test for impairment, and we're going to report it on the books as an impairment loss if in fact it's impaired. So there's a two-step test related to testing for impairment. The fair value gets compared to the carrying value of the consolidated entity's reporting unit. Does the fair value of the reporting unit exceed what we see as the carrying value? If that is yes, the fair value exceeds the reporting value, well, we don't have to do anything with goodwill, we're fine. However, if that fair value doesn't exceed the carrying value, then we need to go to step 2. And basically, how we're going to test for this impairment, we're going to basically determine the value of goodwill, similar to how we initially did it. We're going to allocate the fair value of all those identifiable assets and liabilities. Then from that, subtract